It's December 2025. It's December 2025, while you're being told that everything is fine. The math tells a very different story. Not because anyone is lying, but because the numbers are being ignored. Right now, 14 specific indicators, the same ones that flashed before 1929, before 2000, before 2008, are flashing red once again. Every single one of them points to the same conclusion: a major financial crash is coming, not decades from now, not sometime in the distant future, but within the next 12 to 24 months. The mechanisms are already in motion. The timeline is narrowing, and there is nothing left that can stop the unwind, only delay it. You have roughly 18 months. 18 months to move capital out of fragile assets. 18 months to reduce leverage. 18 months before the largest wealth transfer since 2008 wipes out the unprepared and rewards those who recognize the pattern early. This isn't fear. This isn't speculation. This is mathematical inevitability, and once you see the pattern, the same one repeating for more than a century, you begin to understand why this crash is not just likely, but unavoidable. The US economy is now in the final stage of the longest expansion cycle in modern history. The bull market that began in March 2009 is entering its 16th year. Historically, expansion cycles last 5 to 7 years. The longest cycle before this one lasted 10 years and ended with the dot-com collapse. This cycle has exceeded that record by more than 50%. But crashes are not caused by age alone. They are caused by conditions, specific, measurable conditions that create structural instability. And every major financial collapse in history follows the same four-stage pattern. First comes excessive optimism and rising asset prices. Then, warning indicators begin flashing while being systematically ignored. A trigger event exposes the fragility, and finally, forced selling cascades into collapse. Right now, we are firmly in stage 2. History proves this pattern without exception. In 1929, optimism was universal. The stock market had risen nearly 400% in less than a decade. Margin debt exploded as investors borrowed heavily to amplify gains. The yield curve inverted. Agricultural prices collapsed. Consumer debt surged. Economists insisted everything was fine. 1 month later, the market crashed. The Dow Jones eventually fell 89%. 9,000 banks failed. Unemployment reached 25%. In 2000, the internet convinced an entire generation that old rules no longer applied. Companies with no profits were worth billions. The Nasdaq rose 400% in 5 years. Valuations didn't matter until they did. The index fell 78%. $5 trillion vanished. In 2008, Americans were told housing could never fall. Banks were leveraged 30 to 1. Risk was hidden inside complex securities. Warnings were dismissed. Then Lehman Brothers collapsed. The S&P 500 lost 57%. $11 trillion in household wealth disappeared. Different decades, different stories, the same pattern every time. Now look at today. The total US stock market is valued at roughly $60 trillion, while US GDP is about $26 trillion. That puts the Buffet indicator near 230%, the highest level ever recorded. Before the dot-com crash, it peaked at 148%. Before 2008, it peaked at 105%. Today, it is far beyond both. The Shiller-Cape ratio sits near 39. The historical average is 17. To return to the mean, stock prices must fall more than 50%. Margin debt remains near historic highs. Corporate debt is near 50% of GDP. Commercial real estate values have fallen 40 to 60%, while debt remains intact. Regional banks are exposed. Consumer debt is surging. Savings are gone. Delinquencies are rising. Every major indicator that preceded past collapses is flashing red simultaneously. Between now and 2027, more than $1.5 trillion in commercial real estate loans will mature. Many of those buildings are worth far less than the debt attached to them. Defaults are unavoidable. Banks will absorb the losses. Cheap corporate debt issued at 2% must now be refinanced at 6%. Interest expenses explode. Earnings fall. Prices adjust. Consumers already over-leveraged cut spending. Unemployment rises. The recession isn't coming. It has already begun. Markets remain elevated only because optimism always dies last. But valuations always revert to the mean, always to normalize valuations. The S&P 500 must fall from roughly 6,900 to near 3,000, a decline of 50 to 60%. This is not a forecast. It is arithmetic. In early 2008, those who prepared preserved capital. Those who trusted the optimism lost half their wealth. Today, the indicators are clearer. The debt is higher. The valuations are more extreme. You have about 18 months before the unwind accelerates, before the system breaks. The crash is inevitable. The only question is whether you'll be ready when it happens.